Your HR department made it sound so simple. Contribute to your 401k, get the company match, max it out if you can, do this for 30 years, and retirement is handled. So you did it. You're doing it right now. Every paycheck, money disappears before you even see it, funneling into that account with the growing balance. You've got 6 figures in there, maybe more, and it feels like you're winning. It feels like you're doing exactly what responsible adults are supposed to do. But here's the question nobody's asking out loud, the one that should be keeping financial advisors up at night. Is your 401k actually enough to retire on? Because for about 80% of Americans, when you run the real math, the honest math, the answer is no, not even close. And this isn't a failure of effort. You've been contributing for years, watching that balance climb, trusting the system. This is a failure of strategy. The retirement savings gap in America is now measured in trillions with a T. And the biggest reason is painfully simple. We were sold one tool and told it was the entire toolbox. My name is David, and I need you to stay with me for the next few minutes because we're breaking down exactly why relying on your 401k alone will leave most people dangerously short, what the system has been hiding in plain sight, and what you actually need to build instead. This isn't about fear. This is about facing the math so you can fix it while there's still time. Let's start with the numbers that should make you uncomfortable. The average 401k balance for someone aged 55 to 64, people literally standing at retirement's doorstep, is around $185,000. Now ask yourself what financial planners say you actually need to retire comfortably. The range sits between 1.2 and 1.5 million, depending on your lifestyle and where you live. That's not a small gap. That's a canyon. That's a you're going back to work at 68 gap. And it's swallowing people who did everything right. Even if you've been more disciplined than average, even if you've managed to save $400,000 or $500,000, stay with me on this calculation. Run the 4% rule, the standard guidance that says you can safely withdraw 4% of your retirement savings each year without running out of money. $500,000 gives you $20,000 annually. Add Social Security at the current average, and maybe you're looking at $40,000 to $45,000 a year. If that number just made your stomach drop, if you're thinking that's not even close to maintaining your current life, you're doing the math correctly. Now layer in inflation. Layer in healthcare costs that rise faster than general inflation. Layer in the reality that you might live 25 or 30 years in retirement, maybe more if medicine keeps advancing. Suddenly, that 6-figure 401k balance that felt so impressive starts looking dangerously thin, and the reassurance you got from HR starts feeling like a lie nobody meant to tell, but everybody repeated.
Here's what should genuinely bother you about this situation. This isn't happening to people who ignored retirement planning. This is happening to people who did everything they were told to do. The 401k-Only strategy has a fundamental math problem, and simply contributing more won't fix it because the system itself has limitations nobody wants to talk about. The IRS caps your 401k contributions. For 2024, that cap is $23,000 if you're under 50. It sounds like a lot until you realize that cap is the absolute ceiling on your tax-advantaged retirement growth in that specific account. If you're a high earner trying to catch up, if you started late, if you want any shot at retiring early, that cap just put a hard limit on your timeline. Compare this to a taxable brokerage account for just a moment. No contribution limit, ever. You can invest $50,000, $100,000, whatever you have beyond your 401k maximum. The growth gets taxed differently, sure, but the freedom is real and the ceiling doesn't exist. The 401k cap made perfect sense when the system was designed as a supplement to pensions, but as your only retirement vehicle, it's a bottleneck. You're trying to build wealth through a tunnel that only lets a certain amount through each year, and time is the one resource you can't get back.
Then there's the penalty prison most people don't think about until it's too late. Your 401k comes with a lock built into the fine print. You cannot touch that money before age 59 and a half without paying a 10% penalty plus income taxes on whatever you withdraw. The IRS calls this a retirement account. What they actually built is a cage for your own money. Life doesn't wait until you're 59 and a half. You might want to start a business at 45. You might get laid off at 52 and need a financial bridge. Your kid might need help with something critical when you're 48. The 401k says, too bad, pay the penalty or wait. This isn't about raiding your retirement fund for vacations or luxuries. This is about the fact that all your investment growth is trapped in an account you cannot access during the entire period of your life when you might need flexibility the most. People with real wealth have money in multiple places with different rules and different access points. People with only a 401k have all their eggs in one locked basket, and the key doesn't work for decades. But the part that really gets overlooked, the part that might be the most expensive surprise, is the tax time bomb. Your 401k is tax-deferred, not tax-free. Every dollar you contributed, you avoided taxes on today. Every dollar you withdraw in retirement, you pay full income taxes on tomorrow at whatever the tax rate is when you're 70. You're making a bet right now that your tax rate in retirement will be lower than it is today. Maybe that's true. Maybe it's not. Tax rates change with elections and policy and national debt. Your income in retirement might actually be higher than you think if you planned well. And even if your rate drops slightly, you're still paying taxes on decades of compound growth. That $300,000 you contributed that grew into $1.2 million, you're paying taxes on the full $1.2 million as it comes out. Uncle Sam has been your silent partner this entire time. You just don't see his bill until you're retired and your options are limited. Compare that to a Roth IRA where you pay taxes now but pull everything out tax-free later, or taxable investments held long-term that get preferential capital gains treatment. The 401k isn't a tax escape, it's a tax delay, and delays come with uncertainty baked in.
Now, before someone jumps in, yes, the employer match is free money. Take it, always. If your company matches 4% and you're not contributing enough to capture that full match, you're literally leaving money on the table. That part of the conventional advice is completely correct. But here's what happened over the last 4 decades. The financial services industry, the HR departments, the personal finance books, they took that one solid piece of advice and stretched it into a complete retirement philosophy. Max your 401k became the only advice, the beginning and end of the conversation. And there's a reason that message got amplified so loudly. The 401k system is incredibly profitable for fund managers. Your money sits in their funds for 30 to 40 years. They collect fees the entire time, whether the market goes up, down, or sideways. It's not a conspiracy. It's just a business model that benefits from simplicity. Here's the history they don't mention in those benefits meetings. The 401k was created in 1978 as a supplement to pensions, not a replacement for them. It was a tax loophole that got turned into the primary retirement vehicle for American workers because companies realized they could cut expensive pensions and shift all the investment risk to employees. Now you're responsible for choosing investments, managing contributions, timing the market, and hoping you get it right. The 401k is a genuinely good tool. It's a terrible plan when it's your only plan. And yet that's exactly how it's been sold to 3 generations of workers. So what does a real retirement strategy actually look like when you step back and build it properly? Think of it as 3 buckets working together, each with different rules, different tax treatment, different access. First bucket, the 401k up to the employer match. That's your foundation. Free money, tax deferral, automatic contributions pulled from every paycheck. Do not skip this step. But then you keep building beyond what HR told you. Second bucket, a Roth IRA. You pay taxes on contributions now, but everything it grows into comes out completely tax-free in retirement. For 2024, you can contribute $7,000 if you're under 50. This is your tax-free growth engine. Imagine 30 years of compound returns and 0 taxes on the gains. That's the opposite bet of the 401k, and you want both working for you simultaneously. Third bucket, a taxable brokerage account. No contribution limits, no age restrictions, no penalties for access. You can pull money out next year or in 30 years.
Investments held over a year get taxed at long-term capital gains rates, which for most people is 15%, significantly better than ordinary income rates. This is your freedom money, the account that gives you options before 59.5, the flexibility to handle whatever life throws at you.
Here's a simple allocation that changes everything. Contribute to your 401k up to the employer match, then max your Roth IRA. Then, if you want, go back and increase your 401k contributions. Anything beyond that, taxable brokerage. You're building 3 different tax treatments, 3 different access rules, 3 layers of flexibility and protection. That's not complexity for its own sake, that's durability. That's what wealthy people have been doing quietly while everyone else was told to just max the 401k and hope. If you're just starting out, here's your sequence. Step 1. Contribute enough to your 401k to get the full employer match. Step 2. Open a Roth IRA and set up automatic monthly contributions, even if they're small. Step 3. Open a taxable brokerage account, even if you're only putting in $50 a month at first. The account existing changes how you think about money and options. If you're already contributing to a 401k and have been for years, here's your diagnostic question. What percentage of your total investments can you actually access right now without penalties? If the answer is 0, you don't have a diversification problem. You have a liquidity crisis that just hasn't happened yet. This week, not next month, open one of the other 2 buckets. You don't have to fund it fully. You don't have to have it perfect. You just have to start building the structure. The whole 401k versus investing framing misses the point entirely. It's not versus, it's first, then more. The 401k is step 1. It was never supposed to be the only step, and the people who sold it that way knew better. Financial freedom isn't one account you can't touch for 30 years. It's 3 accounts with different rules working together so that no matter what life does, no matter what the market does, no matter what tax policy does, you have options. Run your numbers tonight. Look at your total invested assets. If 100% of it is locked behind penalties until you're nearly 60, you're not ahead, you're just stuck in a different way. That changes now.